IND AS 38, Intangible Assets, Recognition, Measurement, and Disclosure Deep Dive. Welcome to CandiMentor. Today we're decoding IND AS 38, the Indian accounting standard that governs intangible assets. Assets that you can't physically touch, but that often represent the real value of a business. Think of software, patents, or brand names that drive modern companies forward. Let's walk through it, step by step. End. 1. Objective and Overview. The main objective of IND AS 38 is to set clear principles for how companies should recognize, measure, amortize, and disclose intangible assets. These are assets that lack physical form, unlike buildings or machinery, but still generate measurable future benefits. This standard is based on IAS 38, the international version under IFRS, with a few adjustments for Indian context. The goal is consistency and transparency, so that investors can understand the true value hidden in intellectual property and other intangibles. Typical examples include computer software, licenses and franchises, customer lists, and trademarks, all of which represent valuable long-term rights rather than physical possessions. 2. Definition of an intangible asset. An intangible asset is defined as a non-monetary, identifiable asset without physical substance. Let's break that down. Non-monetary means it's not cash, not a receivable, and not a financial instrument. Identifiable means it can either be separated and sold or arises from legal or contractual rights. The entity must also have control, meaning it has the power to derive benefits and stop others from using it. Finally, the asset must offer probable future economic benefits such as revenue generation or cost reduction. In essence, if it's non-physical but controlled, identifiable, and beneficial, it can qualify as an intangible asset. 3. Recognition conditions under IND AS 38. An intangible asset is recognized only when two strict conditions are both met. 1. It must be probable that future economic benefits will flow to the entity. This could mean increased sales, royalty income, or strategic advantages. 2. The cost of the asset can be measured reliably. If either condition fails, the expenditure is immediately charged to profit and loss. So, costs like staff training, advertising, or startup feasibility work are never capitalized. They're treated as expenses. This rule ensures that only assets with a clear and measurable economic future appear on the balance sheet. End. 4. Identifiability tests. 2 routes. An intangible asset must be identifiable, and IND AS 38 offers 2 clear tests. The separability test. Ask, can this asset be sold, transferred, licensed, or exchanged separately from the business? If yes, it's identifiable. For example, a software license can be sold independently, so it qualifies. The legal rights test. Does the asset arise from legal or contractual rights, regardless of whether it can be sold separately? For instance, patent rights or franchise agreements pass this test. Something like customer loyalty or employee skill, however, fails both tests because they can't be sold or controlled legally. End. 5. Control and future benefits. Control means the company can obtain the benefits from an asset and restrict others from accessing those benefits. This control typically arises from ownership, legal rights, or confidentiality agreements. For example, a company that owns a patented formula has clear control, but it can't claim control over an employee's talent, even if that employee is critical, because they can leave anytime. The benefits from control could appear as higher revenue, cost savings, or improved competitive positioning. 6. Initial recognition. Purchased intangibles. When an intangible asset is purchased or acquired, it is recorded at cost. That cost includes the purchase price, net of discounts, any import duties or non-refundable taxes, directly attributable costs needed to make the asset ready for use, like legal fees, registration, or installation. However, administrative costs, training expenses, advertising, or relocation costs are excluded because they don't directly create or prepare the asset itself. Example, if you buy software and pay legal fees for licensing, both are included in cost, but the cost of training your staff to use it is expensed. 7. Internally generated intangibles, the key rule. Many companies create value internally through branding, customer relationships, or innovation. But IND AS 38 is conservative here. Internally generated goodwill, brands, or customer lists cannot be recognized as assets. To manage this, all internal innovation efforts are divided into 2 phases. Research phase, activities aimed at exploring ideas or possibilities. These are always expensed because there's no guaranteed outcome. Development phase, activities to turn a proven idea into a usable or sellable product. These may be capitalized if specific criteria are met. This split ensures only proven, commercially viable projects are treated as assets. 8. Research phase, always expensed. The research phase involves early exploration, understanding problems, testing concepts, and evaluating feasibility. Since success is uncertain at this point, the costs offer no guaranteed economic benefit. Typical research activities include knowledge gathering, literature review, design alternatives, and prototype experiments. Therefore, every rupee spent during research is charged directly to profit and loss. Example, a biotech company experimenting with several chemical compounds before finding a potential drug. All those costs are expensed immediately because there's no assurance that any compound will work. 9. Development phase can be capitalized. Once the project passes feasibility and moves into actual development, capitalization becomes possible, but only if all 6 strict conditions are met. 1. Project is technically feasible. It can be completed successfully. 2. Management intends to complete it and use or sell the asset. 3. The company has the ability to use or sell it. 4. Future economic benefits are probable. There's market demand or commercial value. 5. The company has adequate resources, both technical and financial, to complete it. 6. Costs can be measured reliably throughout the development process. Example, after testing, a company begins building a market-ready app. From that point onward, development expenses can be capitalized because the project now meets the criteria. Once capitalized, the asset is treated like any other, amortized over its useful life. End. 10. Measurement after recognition. After an intangible asset has been recognized, the company can choose one of 2 measurement models. A. Cost model. This is the default and most commonly used method. The asset stays on the books at its original cost, minus accumulated amortization and any impairment losses. It's simple, consistent, and easy to audit. B. Revaluation model. This is allowed only when there's an active market where identical assets are regularly traded at observable prices. Such markets are rare, but examples include taxi permits, spectrum licenses, or fishing quotas. If revaluation is applied, increases in value go to other comprehensive income, while decreases are charged to profit and loss. 11. Useful life, finite versus indefinite. The useful life of an intangible asset determines how long its benefits are expected to last. Finite life assets are amortized over their useful period. For example, a 5-year software license. Indefinite life assets, like renewable trademarks, have no foreseeable limit to their benefits and are therefore not amortized. However, they must be tested for impairment every year to ensure their carrying value isn't overstated. The distinction matters because it affects both expense timing and balance sheet strength. 12. Amortization method and pattern. Amortization should reflect how the asset's economic benefits are consumed. If that pattern isn't clear, the straight-line method is used, meaning equal expense every year. The useful life and amortization method must be reviewed annually and adjusted if conditions change. Remember, amortization begins only when the asset is ready for use, not when it's purchased. This approach ensures that expenses align with actual benefit consumption. Sign box. 13. Impairment testing, linked with IND AS 36. Every intangible asset must be checked periodically for impairment, a drop in its recoverable value. Compare the asset's carrying amount with its recoverable amount, which is the higher of its value in use, present value of future cash flows, or its fair value less costs to sell. If carrying amount exceeds recoverable amount, record an impairment loss in the profit and loss statement. If later the asset recovers in value, a reversal can be recognized. And for indefinite life assets, this test is mandatory every year, even if there are no signs of impairment. 14. Residual value and amortization period. In most cases, intangible assets have a zero residual value, unless a resale or buyback is contractually guaranteed. Also, their useful life should not exceed 10 years, unless a longer period can be clearly justified. Each reporting period, management must reassess these estimates because technology, competition, or regulation can easily shorten an asset's usefulness. 15. Derecognition of intangible assets. An intangible asset is derecognized when it's either sold or when no future benefits are expected. When sold, the gain or loss is calculated as sale proceeds minus carrying amount and recorded in the profit and loss account. Example, if a company sells its software rights to another firm, any profit from that sale appears as gain on sale in P&L. 16. Disclosure requirements. IND AS 38 demands detailed disclosures in the financial statements to promote transparency. These include the asset's useful life, whether finite or indefinite, the amortization method and the rate used, the gross carrying amount and accumulated amortization, a reconciliation from opening to closing balance, showing additions, disposals, and impairments, details of any impairment losses or reversals, restrictions on ownership or cases where the asset is pledged, commitments to acquire future intangibles. Such disclosures allow users of financial statements to judge how reliable and sustainable those assets really are. 17. Comparison. IND AS 16 versus IND AS 38. Let's draw a quick comparison. IND AS 16 deals with property, plant, and equipment, PPE, tangible assets like machines or buildings. IND AS 38 handles intangible assets, non-physical items like software or patents. Both use the cost model by default and permit revaluation. But under IND AS 38, revaluation is allowed only if an active market exists. Tangible assets often have non-zero residual value, while intangibles usually end up with zero residual value. And where tangible assets depreciate due to physical wear and tear, intangibles are amortized based on benefit consumption. 18. Common mistakes and pitfalls. Here are frequent errors companies make. Capitalizing research costs instead of expensing them. Recording advertising or training costs as intangible assets. Ignoring impairment testing for indefinite life assets. Using the revaluation model without proving an active market. Failing to disclose methods, assumptions, and useful life details in financial notes. Avoiding these mistakes helps maintain both compliance and credibility with auditors. 19. Practical journal entries. Here's how the accounting looks in practice. 1. Purchase of an intangible asset. Intangible asset. Treasury bank or payables. 2. Amortization expense. Amortization expense. Treasury accumulated amortization. 3. Impairment loss. Impairment loss. Treasury intangible asset. Sale of asset. Bank. Accumulated amortization. Treasury intangible asset. Treasury gain on sale, if any. These entries make the life cycle of an intangible asset clear, from purchase to disposal. 20. Audit and valuation focus. Auditors pay close attention to intangible assets because judgment is heavily involved. They check for ownership, control, and existence of the asset, whether capitalization criteria are met for internally developed assets, the reasonableness of useful life estimates, the validity of impairment models and fair value assumptions, and the completeness and accuracy of disclosures. Auditors often request supporting documentation, such as contracts, valuation reports, or technical assessments to validate recognition and measurement. 21. Real-life examples. To see IND AS 38 in action, Infosys capitalizes development costs for its proprietary software once the feasibility and commercial value are proven. Pharma companies expense research costs until the stage where a compound's success is confirmed. Only then do they capitalize. Media companies recognize film rights as intangible assets and amortize them based on expected viewership or revenue. These cases show how diverse industries apply the same standard in tailored ways. 22. Key differences versus IAS 38, IFRS. IND AS 38 is conceptually aligned with IAS 38, but there are minor Indian modifications. Revaluation is strictly permitted only when an active market exists. Regulators and auditors in India typically prefer the cost model for practicality. Disclosures are streamlined under Schedule 3 of the Companies Act 2013, making them simpler but still comprehensive. Thus, while the core principles mirror IFRS, the Indian version ensures more consistency and conservatism. Sign. 23. Summary and closing. To summarize, IND AS 38 defines how to handle the invisible assets that shape modern enterprises. It allows recognition only when future benefits are probable and costs can be reliably measured. Remember the golden rule. Research costs are always expensed, but development costs can become assets once they meet all criteria. After recognition, the cost model is usually preferred, with regular amortization or impairment reviews. Finally, clear disclosures and consistent treatment aren't just compliance tasks. They help build trust with investors, analysts, and regulators. That's IND AS 38 in a nutshell. A complete roadmap for recognizing and managing intangible assets the right way.